Dividend Aristocrats are companies who have raised their dividend for over 25 years in a row. That usually means very stable companies and usually a very safe dividend, but with a lower yield. Well, not anymore. Cue the classical music and let's dive in. Welcome back everyone, I'm the Swedish dividend investor. As Europeans, we are a bit behind on the covered call ETF scene compared to the US and Canada. But things are changing and we do have some alternatives. Some great and some crappy. The ETF we will look at today is KNG, First Trust Vest S&P 500 Dividend Aristocrats Target Income ETF. A monthly paying covered call ETF. As always, this is not financial advice. I'm just sharing my investing journey and my analysis. Read the full disclaimer in the description. If you want to know how covered call ETFs work, I've linked a video in the description where I explain how they work. So make sure to watch that. We do have access to these companies through another ETF with the ticker SPYD, SPDR S&P Dividend Aristocrats ETF. With a quick glance, we see a yield of about 2%. And we see companies like Verizon, Realty Income, Chevron, Pepsi, Coca-Cola, Kimberly-Clark, etc. They have a great track record, and later on we're going to check their total return numbers. However, even with a great dividend growth, for me the yield is way too low. Their dividend is paid quarterly. So let's check out this relatively new ETF for us European investors. Now, this ETF has been around since 2018 in the US, so we do have some historical data. But first, we will check out what this fund does, holdings, sectors and their option strategy. Let's take some seconds to admire the 90s style webpage First Trust uses. The FT Vest S&P 500 Dividend Aristocrats Target Income ETF seeks investment results that corresponds generally to the price and yield of an equity index called CBOE S&P 500 Dividend Aristocrats Target Income Index Monthly Series. The fund will normally invest at least 80% of its total assets in the common stocks and call options that comprise the index. The fund, using an index investment approach, attempts to replicate, before fees and expenses, the performance of the index. Their total expense ratio is 0.75%, and currently the fund size is about 6 million euros. Keep in mind, this is a relatively new ETF in Europe. The assets under management in the US is around $3.5 billion. So, here is their top 10 holdings. Caterpillar, Amcor, Cisco, ExxonMobil, Illinois Toolworks, Johnson & Johnson, Church & Dwight, PepsiCo, Dover Corporation, and Linde plc. Is it Linde or Linde? Linde? Whatever. So, it's nice to not have the usual suspects of Nvidia, Microsoft, etc. in the top. The stocks in KNG are often considered sleep well at night stocks. Their sector allocation is the following: consumer staples 24.31%, industrials 21.79%, financials 11.97%, materials 11.61%, healthcare 10.19%, utilities 6.02%, real estate 4.37%, consumer discretionary 4.16%, energy 3.19%, information technology 2.39%. Very nice. Now, since this is the S&P 500 Dividend Aristocrats, it is 100% US allocation. But as I see it, these companies are pretty global. So what is their option strategy? They do sell at the money options, my least favorite, since you're almost always guaranteeing selling away the upside. However, they are very flexible on the portfolio coverage. In their prospectus, they write the notional value of the covered calls will not exceed 100% of the value of each underlying aristocrat stock. And since they invest up to 80% in the index, the maximum amount of call options is 80%. The rest of the 20% of their asset can be allocated in other assets outside the index, such as bonds or other options to boost either the income or performance. One great thing about First Trust is they actually write their options outstanding. This isn't up to date, but we can at least see what they are doing. We can see option override percentage 18.66%, current month upside participation percentage 81.34%, at the money short call maturity 20th of February 2026. So during December they only sold calls on less than 20% of the portfolio and kept more than 80% for upside participation. Now this is how you run a covered call ETF. If you like my videos, don't forget to like, comment and subscribe. It helps a lot. Thanks. So let's check the American version versus the S&P 500. And I've also gone with the ticker NOBL, ProShares S&P 500 Dividend Aristocrat ETF for the non-covered call version. For price returns, we see the S&P in the lead, followed by NOBL. Looking at total return, we can see NOBL and KNG is neck and neck, a few percentage points only. On the 1 year time frame, we can see the performance is pretty close to the S&P. And looking at the 5 year total return, almost 50%. In my eyes, that is very nice for a covered call ETF. Nothing much happening with the share price, which is actually a good thing since you can buy it consistently. Another great thing about covered call ETFs is the flexibility and freedom you get. The income is substantial. You could either use it, such as for emergencies or going on a vacation, or just reinvest it. It's hard to do that with a 2% yield. Taking a look at their dividend, it seems they changed their strategy and started paying monthly distributions in October of 2023. And looking at the payout, they are somewhat consistent. Their yield in the first years was a bit low, but it hovers around 8 to 9% depending on how well the underlying does. So, now that we have looked at the American version, let's check the competition in Europe. So let's start with the performance of SPYD. Their 5 year total return is around 60%. So, not that big of a difference to the American version. Since KNG is new, we don't have much to go on, but let's compare them since the inception of KNG. So we can see during this time period, KNG is at around 8% and SPYD is at 12%. So a bit different, but I think over time the performance will be a lot closer. As we can see on the chart, they usually stay pretty close in total returns. So to summarize, we got a covered call ETF with blue chip Dividend Aristocrats in their portfolio. They use a very conservative option strategy and they aim to have an annual yield of about 8% and they pay monthly. The performance is positive and I would say the risk is lower than holding the S&P 500 since we don't have the overvalued tech sector. In a downturn, we get dividends that we can reinvest to lower our cost basis. I know WINC, iShares World Equity High Income Active ETF, is often viewed as the best covered call ETF in Europe, and it is great. However, I would say this is a strong contender with less risk since they don't hold any of the highly overvalued tech companies. Not that there is a problem with that, it could boost your returns massively, but I see the downside risk is higher. So here's the truth guys, I actually started a position in KNG during February. I had my eyes on it since inception, and after doing some research, I decided to pull the trigger. During the year, I will make this a huge portion of my invested capital, along with PFFI for the stable income and JGPI, another one of my favorite when it comes to a more conservative portfolio. I want to know what you think about this ETF. Does it have a place in your portfolio, or is it a contender? I know it is small, that's usually the case for all new ETFs. I love it and I plan to buy and hold it for a very long time. But that's it for today. I will see you guys in the next one. Until then, stay smart, stay patient and keep stacking those dividends. Ha det gött!